Right now, in what was supposed to be a quiet ghost week, silver just exposed something dangerous. While most people expected silence, the market delivered violence. In a matter of moments, silver screamed toward $83, then collapsed back toward the mid-70s like the floor vanished. This was not volatility. This was not a mistake. This was the system showing stress, briefly losing control, then snapping back. And what you just saw matters far more than most people realize. Let us slow this down and walk through the scene. Because this move was not random, it happened during Ghost Week, the dead zone between holidays and year-end. When desks are thin, liquidity is missing, and order books are hollow. This is when markets become dangerous. Not because of news, but because of absence. Absence of buyers, absence of depth, absence of protection. Silver was trading calmly. Screens looked normal. Then, in a blink, price accelerated upward. Not gradually, not organically. It jumped, it teleported, within moments. Silver printed levels north of $80. That number alone should have stopped you. Because nothing fundamental changed in that instant. No war headline, no central bank announcement, no supply shock, yet price exploded anyway. That is your first signal. When price moves without cause, it is not discovery. It is stress. Then came the reversal, fast, violent, surgical. Silver collapsed from those extreme highs back into the mid-70 range almost as quickly as it rose. There was no bidding ladder, no gradual support. Just air. Price fell because there was nowhere to land. This is what happens when an order book is empty. Sellers hit the market and there is no one standing in front of them. This was not panic selling by long-term holders. Physical investors were not dumping bars. Industrial users were not canceling contracts. This was a paper event, futures, algorithms, leverage. During Ghost Week, volume dries up naturally. Professional desks know this. Algorithms know this. They watch liquidity the way predators watch terrain. When the ground is soft, that is when the strike comes. Price was allowed to run higher. Intentionally, to draw in momentum traders. Retail money saw green candles and chased. Stops were placed. Leverage piled in. Then the switch flipped. Large blocks of paper silver were sold into the market, not to exit positions, but to push price. As silver dropped, it crossed invisible lines where stop-loss orders were clustered. Those stops fired automatically. One triggered another, then another. What followed was a cascade, forced selling, liquidations, margin calls. A waterfall created entirely by structure, not fear. This is why the move felt unreal, because it was mechanical. And here is the key detail most people missed. After all that violence, after the spike and the crash, silver was still trading well above where it closed just days earlier. Strip away the extreme wick. Ignore the ghost print. Look only at where price settled. That close was strong. That close mattered. This is why this was not a failure. This was a stress test. The system pushed silver upward, lost control for a moment, then slammed it back down to see who would break. Leverage broke. Weak hands broke. The trend did not. This was not the end of the move. This was the move growing teeth. Now we get to the part most people do not want to hear. This move was not an accident. It was a hunt. In modern markets, nothing happens blindly. Large institutions maintain detailed maps of positioning. They know where leverage is building. They know where retail traders place stop losses. They know which price zones are fragile. During normal weeks, liquidity hides this. During Ghost Week, everything is exposed. Silver had become crowded on the long side. Too many traders chasing momentum. Too much borrowed money riding a thin market. That creates instability. And instability attracts predators. The playbook is always the same. First, let price rise. Do not fight it. Allow optimism to build. Let headlines turn bullish. Let traders convince themselves this time is different. As price climbs, leverage increases. Stops move higher. Risk concentrates. Then comes the strike. At the peak, massive blocks of paper silver are dumped into the futures market. Not gradually, all at once. This is not selling to exit. This is selling to move price. The goal is not profit on the sale. The goal is impact. As price starts falling, it crosses the first cluster of stop losses. Those stops become market sell orders. That selling pushes price lower, triggering the next cluster. This is how a decline feeds on itself. Not because people panic, but because machines force them to sell. This is what a liquidation cascade looks like. Cold, mechanical, emotionless. Retail traders think they are protecting themselves with stops. In reality, they are advertising their positions. Institutions do not guess where stops are, they know. And when liquidity is thin, it takes far less capital to reach them. As margin thresholds are breached, brokers liquidate positions automatically. Traders are sold out at the worst possible prices. This is where pain concentrates. This is where accounts are wiped. And this is where the transfer happens. Because waiting below, quietly, are the same institutions that initiated the move. They sell high to trigger the cascade, then they buy low as forced selling floods the market. They repurchase at discounts created by liquidation, not fundamentals. This is why these events always end with sharp bounces. Once forced selling exhausts itself, price snaps back, not because sentiment improved, but because the seller disappeared. This is not market manipulation in the cartoon sense. This is structure. This is how leveraged markets behave under stress. And here is the most important distinction. Leveraged traders were never the foundation of this move. They were passengers, temporary, replaceable. When they were removed, nothing fundamental changed. No mine closed, no factory canceled orders, no vault filled with metal. What changed was positioning. Open interest reset, excess leverage flushed, risk redistributed. That is why this event was healthy for the trend, not destructive. It cleared the weak layer sitting on top of a much deeper demand base. It removed the tourists. It made room. Volatility feels like chaos from the inside. From the outside, it is order being restored. This was not silver breaking down. This was silver shedding weight before the next leg higher. Now this is where the real story begins. Because while paper silver was collapsing on screens, something very different was happening underneath. And this is the part most people never check. When price crashed on futures, you would expect panic if the move were real. You would expect dealers slashing prices. You would expect physical holders rushing to sell. You would expect inventory flooding the market. None of that happened. Retail dealers did not chase the paper drop. Premiums did not collapse. In several cases, premiums widened. Some websites showed delays. Others showed out-of-stock notices. Call for, quote, replaced buy now buttons. That is not how a bear market behaves. This is the first hard line between paper and physical. Paper trades promises, physical trades metal. When paper panics, physical asks one question only: can you deliver? And during this crash, delivery demand did not disappear. It increased. No one was calling dealers saying, get me out. They were calling asking, can you source inventory? That tells you everything. Because in real sell-offs, physical holders crack. They want liquidity, they want cash, they accept discounts. Here, the opposite happened. The reason is simple. Physical investors understand something, leverage traders do not. An ounce does not change because a screen flickers. A bar in a vault does not care about a candle wick. Physical ownership has no stop loss, no margin call, no forced liquidation. So when paper silver collapsed, physical holders did nothing. They watched. This exposed the illusion most people still believe, that futures prices set reality. They do not. They reflect liquidity conditions inside a leveraged system. When that system seizes, price prints lies. And here's the second hard truth. If the crash were real, dealers would have inventory. They would be begging for buyers. Instead, inventory stayed tight. The window to buy at depressed paper prices lasted minutes. Most people never even saw it. By the time orders loaded, price had already bounced. That is not a market drowning in supply. That is a market starved for metal. This is why physical markets move slower. They do not chase volatility. They ignore noise. They price based on availability, not fear. Dealers understand replacement cost. They know if metal leaves the shelf, it cannot be replaced easily at lower prices. So they hold the line. This is why paper can crash while physical does not flinch. Because they are not the same market. One is a leverage casino, the other is a supply chain. And when those two disconnect, the message is clear. The crash was artificial. This was not silver being rejected by the world. This was silver being attacked on paper, while real demand stood firm. When paper collapses and physical holds, it is not weakness. It is compression. Pressure building under the surface, and compression does not release politely. Here is the question that decides everything. If silver truly failed, who was buying when price collapsed? Because every seller needs a buyer, and buyers tell the truth. It was not retail traders. They were being liquidated. It was not momentum chasers. They were frozen or wiped out. It was not physical stackers dumping metal. They did not move. The real buyers were industrial, solar manufacturers, electronics producers, defense suppliers, companies that do not speculate on silver. They consume it. They do not care about candles. They care about delivery schedules. These buyers never chase price. When silver screamed toward extreme levels, they waited. They always wait. Because they know volatility creates opportunity, and when the paper market broke, they stepped in. This is inelastic demand in action. For an industrial buyer, silver is a cost input, not a trade. The difference between paying $74 and $80 per ounce barely moves the needle compared to missing a shipment deadline, lose silver, and production stops. Miss production, and revenue collapses. That math is simple. So when paper selling flooded the market, these buyers did not panic. They celebrated. They used the crash to lock in supply. They converted paper weakness into physical delivery requests. This is the moment most charts do not show you. While traders saw red, procurement managers hit buy buttons, hedging software lit up, contracts were secured, metal was spoken for. This is why price bounced where it did, not randomly, precisely where old resistance turned into new support. That bounce was not speculative. It was structural. This is how staircases form. Higher lows, each dip met by stronger hands, each flush removing weaker participants, each recovery starting from a higher floor. This is also why inventory behavior matters next. In real crashes, inventory rises because people sell metal back into the system. In manipulated flushes, inventory falls because industrial users take delivery. If vault data shows outflows while price declines, that is not bearish divergence. That is shortage being revealed. And this is why calling this move a failure misses the point entirely. The crash did not destroy demand. It activated it. Weak hands were forced out. Strong hands stepped in. That is not distribution. That is accumulation. The market did not ask who wants to sell silver. It asked who must own it. And those buyers answered loudly, even if quietly. This is the kind of buying that does not disappear tomorrow. It does not use stops. It does not leverage. It does not panic. It simply absorbs, and absorption is how trends survive violence. You do not get rid of inelastic demand with a paper crash. You feed it. This was not silver losing support. This was silver finding it. Now, step back, because this is where the story stops being about one violent candle and starts being about system timing. Volatility is not random. It serves a function. And in this case, volatility acted as a tax. A tax on leverage, anyone trading futures. 2. Options, or margin paid that tax in full. Accounts were hit. Positions were reduced. Open interest was flushed. This always hurts in the moment, but structurally, it is exactly what strong trends require before they can continue. Markets do not like overcrowding. When too many people lean the same way with borrowed money, the system becomes unstable. It has to reset, and it always chooses the most painful moment to do it. Thin liquidity, holiday weeks, when defenses are down, that reset just happened. Now, look at what matters next. Not the intraday spike, not the wick, the close. Monthly and yearly closes matter far more than daily noise. Pension funds do not allocate based on 5-minute charts. They look at monthly trends. They look at structure. They look at confirmation. And here is the critical point. Even after all that violence, silver is still sitting dramatically higher than it was weeks ago. That alone tells you the trend survived. Gold confirms this. If silver were truly broken, gold would not be calm. Gold would have cracked. Instead, gold remains near record highs, barely flinching. That tells you the monetary floor is intact. Silver simply ran ahead of itself and got snapped back into formation. Gold is the anchor, silver is the elastic. When gold holds and silver flushes leverage, that is not bearish, that is preparation. This is why January matters. Institutional money does not like buying peaks. It likes buying strength after correction. It likes entering after risk is reduced. This crash did that work for them. It cleared the runway. Pension funds looking to enter in January now see a market that already flushed excess. A market with higher lows. A market supported by physical demand. A market with gold confirming the macro backdrop. From their perspective, this was not chaos. This was a discount. If prices had stayed pinned at extreme highs, many funds would have hesitated. Now, they see opportunity. Billions prefer to enter here rather than chase later. This is why algorithms may step back temporarily. Elevated daily volatility forces them to reduce position sizes. That creates chop, boredom, frustration, exactly the environment that shakes out impatient money, and that is the final test. Strong trends do not fail during excitement, they fail during exhaustion. This market is not exhausted, it is resetting. The crash did not end the bull, it prepared it. Leverage is gone, demand remains, gold confirms, January waits. That combination is not a warning. It is a setup. With less than 48 hours left in the trading year, noise will increase and clarity will drop. That is by design. So forget opinions, watch signals. Signal 1, the Asia Open. If silver opens firm while the West is asleep, that tells you demand leads price. Signal 2, Western reaction. Do desks chase or do they freeze? Chasing confirms stress. Signal 3, physical premiums. If paper drifts while premiums hold or rise, scarcity is winning. Signal 4, availability. Out of stock. Call for, quote, delays. These matter more than candles. Signal 5, volatility versus volume. Big moves on light volume signal, liquidity vacuum, not weakness. Remember this, in surplus markets, paper sets the price. In deficit markets, physical decides who survives,